Good evening, class, and welcome to our advanced taxation class for today. Today, we'll be taking the first part of the oil and gas taxation. This is also called petroleum profit tax. We'll be talking about the petroleum industry, the oil and gas sector, and how it is being taxed. So, today, we'll be focusing more on the theoretical aspect so that you can understand the calculation aspect when it comes later. All right, so this is a very wide topic and we are going to be taking relevant aspects. So that's it. Introduction to the topic. Nigeria produces about 2 million barrels of crude oil per day and it's ranked among the top 20 largest producers of oil in the world. So we are an oil producing country like Nigeria, and the oil and gas sector accounts for 60% of the government's total revenue. So it means that 60% of all the revenue that government gets in her businesses come from oil. No wonder oil is the new gold in Nigeria. After oil, we get taxation. So of the total revenue for oil, 90% of it comes from foreign exchange receipts. So it means that when we produce the oil, we will most likely want to export it and earn foreign currency. So foreign exchange receipts accounts for the 90%. All tiers of government depends on oil money. Then, as Nigeria is producing 2 million barrels of crude per day, they don't give out everything. They have some reserves. And so we have our reserves are estimated to be over 37 billion barrels. So what's the essence of our reserves? Such that if anything happens, we can fall back on the reserves. In addition to the crude oil reserves, Nigeria also is blessed with abundant reserves of natural gas. So we have crude oil, we have natural gas. That's why you see oil and gas taxation. The large deposit of gas encountered in the search for oil has led many experts to describe the Nigerian petroleum field as a gas province with some oil in it. So you see, it is not just petroleum profit tax. We are also getting taxed from the gas production. So Nigeria's natural gas reserve has been estimated to be over 192 trillion standard cubic feet. So you see, it is a big business. Within the last decade, some of the existing operators in the petroleum industry or sector, in the some of the existing operators in the petroleum sector in joint venture with NNPC now have organized some gas utilization projects. We'll talk about some of these joint ventures. Some of these joint ventures, it means that they are a separate entity, separate legal entity. But when it comes to the oil business, they join forces with the NNPC and they become joint ventures, and they have, like a partnership. They have profit sharing ratio, and they also have capital contribution ratio. And so that's how these joint ventures in the petroleum industry have with the NNPC. And so they have also, apart from the oil business that brings them into these joint ventures, they are also having gas utilization. And most of these projects are in relation to associated gas. So when we say associated gas, it means you are searching for oil, but in your search for oil, you also find gas together with the oil. That's why they call it associated gas. It's just like accessories. It's just like you're buying phone accessories. You want to buy phone and it comes with charger, it comes with earphone. These are accessories. So the gas is associated now with the oil. It is called associated gas. Their aim here is not to discover gas, it's to search for oil while they get gas as a kind of jara. Then we also have unassociated gas deposits. This is solely searching for gas. All right, so we'll also skip the general overview of oil and gas in Nigeria. We'll skip that. Just note that the Shell, the Nigerian Petroleum Company, the Shell, the AGIP, all of them play a role in the gas, oil and gas development in Nigeria. Now let's look at the roles of regulatory agencies in the oil and gas industry. Regulatory agencies. Who are they? The first one here is the NNPC. NNPC is the major regulatory agency in the oil and gas industry. Of course, NNPC is Nigerian National Petroleum Company. It was corporation rather. It was established by an act of number 33 of April 1, 1977, and it is empowered to be the only authority charged with petroleum activities in Nigeria. Of course, NNPC is now a limited company, but we are going to be looking at it as though it is still under the government control. Now we have the subsidiaries of NNPC. That means NNPC floats other companies. They float other companies, and these companies that they float, they are the parent company. They are the major company financing it. In fact, they all form part of the NNPC group. So when you hear Group Managing Director of NNPC, it is NNPC as a parent and these subsidiaries coming together to form that group. Some of them here, we have the National Petroleum Investment Management Service. Now, this is the investment arm of NNPC, which administers NNPC share of joint venture operations. So if NNPC is going into joint venture with any oil company, they go there with their NAPIMS. They send the NAPIMS. This is their investment arm. Then we also have the PPMC, which is the Petroleum Profit Marketing Company. Now, this company have the responsibility of selling refined petroleum and finished products, which will include gasoline, diesel, engine, grease, and other derivatives. So this PPMC is the downstream sector. They are in the downstream sector. So they are involved in selling refined petroleum products. They are not into exploration. They are into the byproducts after the upstream has finished. This is a downstream arm of NNPC. Whereas the first one is just the financing arm, investment arm. Then we have the third one, the Nigerian Petroleum Development Company, NPDC. Now, this is the upstream arm, the arm that is engaged in oil exploration, drilling of appraisal wells, oil development, production. Then we also have abandonment, which encompasses environmental impact assessment, effluent monitoring, testing, facility demobilization, even decommissioning. All right. Now, NNPC has joint partners in this oil upstream sector. We have the Shell, SPDC, and the Chevron, and we also have contract partners. So, but mainly it is Shell and Chevron that are major partners. Then we also have the Nigerian petrochemical companies. These are in Kaduna and Warri. Then we have the refineries, two in Port Harcourt and one in Warri and Kaduna. So these are the subsidiaries that form the NNPC group. You may not need to know about this now because it may not be tested. Just know that when you have the NNPC group, these are the subsidiaries. Now, looking at some of these, we said this is the investment arm, the NAPIMS. Now, the NAPIMS manages the federal government's interest in the oil and gas industry. So, whenever the oil and gas industry in Nigeria wants to, you know, do anything about this, the NAPIMS usually is the one that does that for them. So, the roles and responsibility are as follows: management of Nigerian government assets, prosecution of Nigeria government agenda, defining operational direction, and spearheading new technology application in the oil and gas industry. So we also have the Department of Petroleum Resources. Now their roles include issuing of and approving of licenses for refineries, fertilizer plants, jetties, depots, lube blending, retail outlets. They also ensure prompt nomination of crude, the consent and NGL export vessels. They also ensure the integrity of the downstream oil and gas facility. In fact, most of their things here are in the downstream sector. We now go to the next regulatory body in the oil and gas tax in the oil and gas industry. We've talked about the NNPC, we've seen their subsidiaries. Now we have the FIROS, the Federal Inland Revenue. Now, the Federal Inland Revenue collects petroleum profit tax on behalf of the federal government. So they are the ones that collect the um, the tax for the federal government. So with respect, the FRS, with respect to the Petroleum Profit Act, is given under Section 3 of the PPA Act. The schedule specifically highlighted the powers that cannot be delegated under the FIROS section. That is not that important for here, but you know here that the Federal Inland Revenue collects non-oil taxation, whereas the NNPC helps the federal government to collect the the tax levied um on the petroleum companies, and the NNPC will remit these taxes to the government. So that's why sometimes when you see the FIRS report, you'll be seeing non-oil taxation, non-oil taxes. Okay, so mostly it is being collected, the taxes is being um, collected by the NNPC. The Central Bank of Nigeria, so the CBN, the sale of crude oil is paid for in foreign currency. So when they sell crude oil and it's being paid in foreign currency, it is paid into the federal government designated bank overseas. Then when it is being, because now let's say we are selling to, let's say, US, and US is paying to Nigeria. Nigeria have um, an overseas account in the US. And so they pay it into that federal government of Nigeria account in the US, for example. Then the proceeds is transferred from that foreign bank to the Central Bank of Nigeria. And so that's where the CBN comes in. So we've seen it's not that the CBN is regulating office petroleum activities, is the NNPC, but the proceeds doesn't go to NNPC, it goes to the federal government account sent to the CBN. All right. We'll skip the effects of the provision of the PIG bill and go now to fiscal operating arrangement in the upstream sector. So when we say upstream sector, what do we mean? We mean all the activities in the oil industry or the oil and gas industry, which begins from searching and exploration of oil to winning of oil, mining it, and getting it ready for exportation, or getting it ready to be sent to the crude oil, to the refineries. So when it is now in the crude form, put in barrels. So you start from searching for oil, you see the oil, you extract it, or I would say you win it, you put them in barrels. Once you put them in barrels, you've cocked them and seal them, oil upstream sector ends. Okay, you put them in in barrels, and it is ready for export. Now, the downstream starts from this transportation of this oil to where it is the intended destination. It also contains the refining of this oil, separating them into its components and its associated gas. All those ones are in the downstream sector. So let's look at the upstream sector and talk a little about them. We have the joint venture. A joint venture is a contractual agreement whereby two or more parties undertake an economic activity which is subject to contractually agreed basis of control, sharing control. It's just like a partnership. Joint venture is a kind of partnership. You see, in the case of partnership, two individuals come in, but joint venture, it could be two companies, it could be two individuals. But in the case of oil company, it's usually NNPC on the one hand and other participating companies. Companies producing crude oil in Nigeria are not allowed to produce the oil solely on their own. And so you can't say that you are an oil company. You must be in partnership with the NNPC. You must enter into a joint venture. So Shell is in partnership with NNPC, Chevron is there, Agip is there, all other oil companies that are into producing oil, they have partnership, they have a joint venture with Nigeria. Now, when they get into this joint venture, there is usually a detailed agreement that will spell out their duties and rights and obligation. Now, in this joint venture, NNPC usually takes up a majority of the venture. So what does this mean? They take up majority of this venture, so that gives them control. It gives them control. So it means that NNPC could take, let's say, 60%, and the remaining 40 could be shared by four companies, each of them 10%. That's how it is sometimes. So NNPC usually takes up control, takes up a large portion. Now, because it takes up the large portion, you will expect NNPC to be a major financier of the oil and gas industry. You will also expect them to do major work in the oil and gas industry, but they don't do anything. They only just get control. You will expect them also to make more profits than the oil companies. Yes. And you will expect them to pay taxes, more taxes than the oil company. All right. So, um, one of the parties in the joint venture is usually given the responsibility to operate the venture. That is the production of crude from the concession that is subject to the venture. So that is called the operator. So let's say the joint venture NNPC have with Shell and other some smaller joint contract companies. Shell might be given the operator rights. So they are the ones that is charged with the responsibility of operating the venture. The operator is the party that conducts the operations under a joint venture, and that includes the drilling of the well from the tract of field that is under the agreement or the contract. So, in spite of all these activities carried out by this company, NNPC is still the majority shareholder. Now, each party to the joint venture is expected to fund its equity share in the venture. So it means, let's say now, NNPC has 60%, maybe Shell has 20, and two other companies are sharing 10-10. And they say, okay, Shell, you are the operator. When it comes for sharing their venture capital, which is sometimes called cash call. So when I say cash call, it means they are calling for cash. So look at how it goes. NNPC has an operator. We are calling it Shell. Shell is given the exploration right. Go and explore the field. This is the field we give to you. Don't go beyond that. Go and explore. When you explore, it means you are searching for commercial quantities of oil. Now, they will use their money and do this exploration. When they use their money and they they get this exploration and they see that they have struck struck oil in commercial quantities, they will look at it and estimate how much they are going to spend in winning this oil, that is lifting it and making it into crude. Now, they will now call for cash. Let's say they need 1 billion naira. NNPC has 60%. NNPC will pay 60% of that. Now, the operator, Shell, um, will pay its own 20%. That 20% will include those aspects that it has spent, those money it has spent, those costs it has spent, it will be included in the overall cost. So let's say they have spent 1 million and they're expected to spend 200 million. They will just simply bring 199 million because they have spent 1 million already. Then every other venture is going to pay for their own cash call. So the operator calls for cash, everybody responds and pay up their venture share. Each party also lifts crude oil and they are from the crude oil produced. So when the crude oil produced is being produced, each of the party will collect their own share in relation to their joint venture interest proportion, the sharing profit sharing ratio. Sometimes it's used based on capital contribution ratios. You can say the capital contribution ratio may be the profit sharing ratio. They might use a different method. They might say NNPC might take say 50%, then the others might share it equally. And so the way that the profit is being shared, that is the profit ratio they will share the crude. So the operator brings the crude, of course, the expenses it has made, it will remove it from what is paying. Then the crude, let's say we have 1 million barrels produced per day. Let's give an example. Of course, we produce more than that. Each of the venture will take their own share. And so that is how they are going to lift their own. Then they are going to sell and make money. When they sell and they make money, they are going to pay tax on what they sell. Now, most times, most times, instead of paying tax on on theirs, sometimes they pay it in the form of oil. Okay, so NNPC, when it lifts up its own share of the crude oil, it may want to do anything it wants to do. It may want to give it to refineries, it may want to do other things. But when NNPC is unable to sell all its shares produced, it will go under a special arrangement with the operator to help sell off and pass the proceed to the NNPC. So it means that they're going to get a little discount for helping them lift this oil and sell it. So let's say Shell is making some money helping the NNPC to sell its share that NNPC cannot sell. So that is the joint ventures. Joint ventures, no company in the oil sector does oil business on its own. You cannot be an island. You must go into joint operation with the NNPC. There is an operator who does the majority of the work. When there is time for cash calls, the NNPC and others are called to bring cash. The operator does everything. He brings the crude oil. It's ready. then everybody comes and take their own share, and life goes on. We also have the production sharing contract, which is called the PSC. PSC. Now, it is also called the deep offshore and inland basin. Now, there is something called the deep offshore inland basin and petroleum profit sharing act, which is specifically addressing this PSC company. Okay, now in the exam, if you are not told that this oil company is a PSC company, do not assume that it's a PSC company. In all cases, by default, assume that they are in a joint venture, except you are told specifically that they are PSC, don't assume that. Now, the petroleum sharing contract, the petroleum producing company enter into agreement with NNPC, of course, for the production of crude oil in particular oil fields respectively. Now, the thing is, the operating expenses for the petroleum will be met by each operator. Okay, so the difference between the production sharing contract and the joint venture is that for the joint venture, their expenses are part of the operational expenses of the venture, which they would incur first. So, like as I told before, if the joint venture make an expense, it is included in the whole cost and they will recoup it. But in the case of PSC, you are on your own. The operation is the operational expenses is funded 100% by the production company. So it means that if you're exploring and you didn't find any oil, you have lost the money you invested. NNPC, there is nothing like cash calls. There is nothing like cash calls. Unlike in the case of joint venture, if there is any loss, everybody will share in it. That's why it's a joint venture. Here, the oil companies in PSC, they are on their own. NNPC will just be sitting down and be watching, and you'll be watching and say, okay, go and look for oil on your own. Of course, we are into contracts. You are into a contract and into an agreement, but you go and look for this oil on your own. So the provision for reimbursement of costs to the operator in executing the contract will be contained in the PSC, and it is usually in the form of the oil produced. So what happens when the petroleum production sharing contract now strike oil? It means the oil that they produce, let me use another company now. I've used Shell for joint venture. Let me use let's say Ajib for petroleum production sharing contract. And let's say Ajib and other smaller companies, they go into this PSC and they are on their own. They go and now there's now struck oil. They now do everything. They now do everything in making sure that this oil is being weaned and they are now ready for exportation. Now, one thing about the production sharing contract is that they go deep offshore. When we say offshore, offshore means into the sea basin, into the sea basin. So that's why you are saying inland basin, deep into the ocean. When we say onshore, onshore means land. Offshore means inside the water. So it is deep inside the water. Unlike in the joint venture where you can get it just inland, inland, and that is offshore, onshore, or if they are going into offshore, they will not go deep, right? The PSC companies go deep, 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 deep down, even up to 1,000 meters be below the seabed. So when they get all this cost that is being incurred is very huge. And now when they now is now ready to be sold, NNPC will now rear its head and say, okay, hold on a moment. Before you do anything else, remember you have an agreement and I'm the major shareholder. All right. We are going to split this oil that you have produced into four sectors. The first one is you know that you have royalty to pay to the government by virtue of the fact that you are exploring oil in Nigeria. You must pay royalty. So as long as you are an oil explorer in Nigeria, you have a royalty to pay. And what's the royalty? They calculate your royalty for you. And so when you now look at it, all of you are supposed to pay royalty. This your royalty, let's say it's 15% of your costs, or let's say there's a particular way in which they share the royalty, and everybody now pays their royalty because they have spent money in producing all of these things. So NNPC will not be reasonable if they ask them to pay them in cash. So they will say, okay, look at this oil that you have produced. This royalty will be converted into oil barrels. So it means that if you are supposed to pay 1 billion naira as royalty, they will bring out 1 billion naira worth of oil and they will keep it aside. NNPC will collect it as royalty oil. So they will record it as royalty oil. All right. So it means that the royalty oil, this goes to NNPC. All right. The next one here is cost oil. So the NNPC will say, all right, you guys have incurred a lot of cost, and thank God everything goes well. Now, how much did you incur? These are your costs. Now, let's say you incur 10 billion in making it. They are going to bring 10 billion naira worth of oil and bring it, and it will be given to the companies, to the so that or those that are involved. So there is no cost oil. So these are the companies. The companies will take this oil as their cost oil. So this is what is representing the oil. So this is like a reimbursement of the cost of running the contract 100%. Then, of course, you have royalty oil goes to NNPC. Now, cost oil goes to the companies. Then it is still remaining. It's still remaining. Then you have your costs. So royalty has gone, cost has gone. The remaining is available for sale, right? The remainder is available for sale. So what will happen? If they will look at that remainder that is available for sale, right? They will calculate how much they are going to sell them, how much they are going to sell, and the profit on it. They are going to calculate tax on the profit. So that tax that they calculate on the operations of all these companies, NNPC is collecting tax oil. So instead of them paying tax in by cash, they will pay it they'll pay it by oil. So NNPC has royalty oil. They also have the tax oil, which they have collected from the PSC company. Then the profit oil, of course, this is the profit after tax. The profit after tax is now being taxed and is now being shared according to the profit sharing ratio. And so this is where all of them, NNPC and the companies, they all pay their profit sharing ratio. And so what happened is that NNPC will now take its share of profit oil along with the tax oil and the royalty oil. And they might just decide to call an operator or to call one of the companies to help them sell these things to them for them. And so all that the NNPC will just be doing here is to allocate, is to collect their own share. And they will not even go with it. They will now give it to maybe one or two of the companies. Please help us and sell it and pay it into our coffers. And so someone will say NNPC just came to reap where they did not sow, where they didn't work, and they are cutting away with everything that almost many of the things that is being um, gotten from the oil business. So anybody that wants to go into an oil company um, upstream sector, you must be very, very, very rich because this is capital intensive. All right. So, what are some of the key provisions in the Deep Offshore and Inland Basin Production Sharing Contract Act? And that's the act. So, one, petroleum profits applicable to the contract area, there shall be 50% flat rate of chargeable profit for the duration of the petroleum profit contract. What it means here is that the rate, the tax rate here, the tax rate is 50% of the profit. So they are going to pay 50% profit tax. Then in capital expenditure wholly and necessarily, in short, I'll say REN, any capital expenditure that um, qualifies for REN, okay, then there are also other provisions. For example, the investment tax credit, which is tax, okay, ITC, call it ITC, is 50%. So one of the things you'll be knowing the production sharing contract is they have 50%. Okay, 50%. So this is like the capital allowance. It's called the investment tax credit. All right. So if executed after July 1998, there shall be due to such parties an investment tax credit allowance at a flat rate of 50%. So the ITC here is 50%. So We've seen 250s, 50% tax rate, 50% investment tax credit. So one of the things you should do in an exam question is this. As soon as you see that a question is telling you that it is an oil company, look out for any signal that it is a PSC company. They might mention the word PSC, they might mention deep offshore. That's another thing to watch out. They might mention deep offshore and inland basin. They might also mention the word production sharing contract. They might even make sure the full act, deep offshore and inland basin production sharing contract act. If you see any of these in that question, just know that this is PSC company. Sometimes you can also see investment tax credit. So that's another way to know this is a PSC company. And the moment you know it's a PSC company, then your 50-50 starts activating. Your tax rate is 50%, non-negotiable. Your investment tax credit, which is like your capital allowance, is 50%. Then royalty. Royalty shared as follows. We have onshore production. If there is onshore, which is inland, your royalty payable is 20%. If it is offshore, it means that you are in the sea. And if it is from the sea bed up from the sea top down to 100 meters depth, you'll be paying 18 and a half. And the moment you go down a little, the more down you go, the lower the royalty you pay. If it is between 100 to 200, you pay 16 to third. If it is between 200 to 500, you pay 12%. If it is from 501 to 800, you pay 8%. If it is from 801 to 1000 meters, you pay 4%. And if it is above 1000 meters, you don't pay royalty. So don't be afraid. Some of these rates will be given to you in the exam if you need it. Then computation and payment of estimated and final petroleum profit tax shall be made in the US dollars on the basis of the US dollar returns filed. So on the basis of US dollar returns filed to be made in US dollars. Now, what do they mean by um, estimated and final petroleum profit tax? Now, this is what they mean. Now, the petroleum company usually have their year end as 31st December every year, just the same way government fiscal year ends. They follow the same way, 31st December. And so, for every year, when it gets to the second year and second month, that means between January and February, the company, the petroleum company, will do an estimated profit and tax for the year. So it means that they are going to, between January and February, estimate how much, how much that the petroleum profits will be and the taxes they are going to pay for the whole year. So it means that it's just like a budget. And so when they make this estimated profit and tax, they are going to now divide the taxes for the year by 12, and they will be paying it every month beginning from March. So from March, it is going to be due on March ending. They pay the first part. In April, they pay the second part. In May, they pay the third part. At any point in time when they feel that the estimate that they have done is not reasonable, they can do a revised estimate. It could be up, it could be down. So when they do a revised estimate, let's say the first estimate says that the tax is going to be 12 million. Just use, okay, 12 billion, and they divide it into 12, and they are paying 1 billion every month. They now do again, and they see that maybe after 3 months, they now find out that our estimate is not realistic. It's going to be 18 billion, right? It's going to be 18 billion. And so what happened is this, is that since it is 18 billion, all they will now do is 18 billion is the estimated, right? How much have we paid so far? They will minus all that they have paid so far in the old estimate. The remainder, they are going to divide it according to the remaining number of months. So we have done for 3 months, that means 9 months remaining. They are going to share the remainder in the 9 months. Let's say another 3 months down the line, they now say, no, it is no longer 18 billion. Oh. It was supposed to be 15 billion. All right. They will now look at the 15 billion, and they will now minus all that they have paid from March down to maybe June, July, or August, where this revised estimate was made. They will minus it, and the remainder, they are going to share it in the remaining life of the um, company. So it means that that is what they'll do. Then at the end of December, December is when the whole as at December 31st, every operation for that fiscal year or that year of assessment is now known, is actual now. So between January, January, there will be between January to May, they will prepare their account. Okay, up to June, they will prepare their account, and they will look at the actual operations that has taken place, the actual operations that have taken place. And based on the actuals, that's why you're seeing based on final. So as they are still preparing, they are still paying the estimated tax based on what they calculated in the estimate. When they have now done their audit, and this is the final activity, actual activity, all they will now do look at is, this is the total tax that we are supposed to pay actually. Now, minus the estimated that they have been paying, the difference is the final petroleum profit tax. So it means that the oil company, they pay estimated every month, because oil is a business that the oil government depends so much on. They cannot wait till the end of the year, and they want to regulate it such that everybody is paying at the same time. Due date is the end of the month. So they are getting money to fund projects, and any default attracts stiff penalty, and so they don't even dare to default. So that is, they calculate estimated and final tax. The corporation or the holders, the case may be, shall pay royalty, concession rentals, and petroleum profit tax on behalf of itself and the corporation out of the allocated royalty and tax oil, meaning that NNPC, who is the corporation, or the arm that is sent to do that for them will pay their own allocated part of the royalty to government. They will also pay their own tax. So it means that they help government to collect royalty money or royalty oil. When they are calculating tax oil, they're also going to calculate theirs, and that is their own tax. They will collect it too. Then profit will be shared for that company. That is how the company make their own profit. So that is what they will do. Then separate tax receipts in the name of the corporation and the contractor for the respective amount of petroleum profit tax paid on their behalf shall be issued by the FIRS in accordance with the terms of production. So while the NNPC helps in collecting this tax oil and selling it and all that, when it has been accounted for, because it is as good as being paid when they collect it in oil. When it has been accounted for and appropriate communication given to the FIRS, you see them getting their tax receipts, or I will even say their tax clearance from the FIRS. So here, while the FIRS will collect the tax eventually, they are not the ones pursuing the petroleum profit tax. So that's why most times you'll be hearing them talking about non-oil tax. Of course, if they want to give you full tax collection, you will see them put both oil and non-oil. But when when FRS is getting their own target, they will be targeting just for non-oil because that is where they have full jurisdiction to pursue tax. The chargeable tax on petroleum operation in the contract area under the production sharing contract shall be split between the corporation and the contract in the same ratio as spelled out in their in the profit oil. So the profit oil and their taxes will be shared the same way. So when they calculate the tax oil, the chargeable tax, and they are collecting tax oil, the same profit sharing ratio will be applied. So when they calculated the whole tax, and maybe they say this is 100 billion, NNPC that has 60% will pay 60% of that. Others will pay according to their ratio, and they will take it as oil, and that's it. So you see, this is a very important thing here to take note of these key provisions, because you may be asked to talk about it, but the calculation part, you may be asked to do it. Most times, they don't give us I would say that most PPT question do not come as PSC, but here and there, one or two or three, you've seen PPA giving you PSC company doing tax. But majority of the time, it is the joint ventures. So, but that's why you need to know. They might ask you a question on PSC, maybe orally, and maybe ask you to do a calculation on joint venture. All right. So we look at the Deep Offshore and Inland Basin Sharing Contract Act 2019. So this is now in the coming in of the Finance Act. The amendment is in line with the provision of Section 16 of the Deep Deep Offshore Inland Basin and Petrol Production Sharing Contract Act, now, which requires the federal government to review the provision of the act when the price of crude exceeds $20 per barrel in real terms or within a fixed number of years. Now, the Amendment Act introduces four key changes as follows. One, the replacement of the royalty regime applicable to deep offshore and oil inland basin, the replacement of the royalty regime. Now, this Amendment Act introduced a combined production and price-based royalty system to replace the existing production-based royalty system. So normally the production system here was royalty. If you produce 20%, 18%, this is the rate. But now it's been replaced, so you may not see this rate. So this is the rate here. They said the new royalty regime specified a royalty of 10% for crude oil and condensates produced in the deep offshore greater than 200 meters depth and 7.5 for the frontier and inland basin. In addition to the baseline royalty, a royalty based on the application price of crude oil and condensate and natural gas will apply, but only when the price exceeds $20 per barrel. And now you see here, look at the rate here. If the royalty rates, when the price is between 0 to 20%, they are $0 to $20, they will pay 0% as royalty. But the moment the price goes above 20% and up to 60, sorry, $20 and up to $60, they are paying 2.5. When it goes above $60 and up to 100, they are paying 4.0. Between 100 and $150 is 8.0. It is above $150, they are paying 10%. That's why the royalty is telling you that the baseline is 10%. All right. So the level of impact of the level of impact the new regime will have on the total government take and total contractor take will depend on the current royalty rate applicable to the current contract area. So just know that this is one of the changes from the production based to price based, a combination of price and production, a combination of price and production. Okay. Then the second one is deletion of section 16 of the act. Now it says that the provision of this act shall be subject to review to ensure that if the price of crude oil at any time exceeds $20 per barrel, the share of the government of the federation in addition to the revenue shall be adjusted under the production sharing contract to such extent that the production sharing contract shall be economically beneficial to the government. So once it exceeds 20%, and $20 where they will now start paying royalty, the the um the contract, the 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 contract sharing ratio so will need to be adjusted. Now, notwithstanding the provision of subsection 1 of this section, the provision of this act shall be liable to review after a period of 15 years from the commencement and every 5 years thereafter. So it commenced when? Commenced in 2019 and 2020. And so for the first 15 years, it is going to be liable to review. After that, they'll be reviewing it every five years. That's another adjustment here. The above section has been a subject of controversy, even resulting in a consent judgment delivered by the Supreme Court in Nigeria. We'll not talk about that now. Then the third one is Introduction of a new Section 16. So this is the old Section 16. They delete it, they now replace it with a new Section 16. Now, this section mandates the Minister of Petroleum Resources. Most times here, Minister of Petroleum Resources, since the Buhari regime happens to be the president. So it mandates the Minister of Petroleum Resources minister to cause the Nigerian National Petroleum Company to call for a review of the PSC every 8 years. So it could be that each time a new government comes in, sometimes they stay up to 8 years. So when a new one comes in, we call for a review. Now, the Act defines that the PSC as any agreement or arrangement between the NNPC, which is the corporation, and any other petroleum exploration and production companies for the purpose of exploration and production of oil in the deep offshore and inland basin. So this means that there could be PSCs solely executed between oil companies without the NNPC involvement. So here is an adjustment here that there could be an involvement, there could be a PSC without the NNPC's involvement. Then we have the introduction of offense and penalty for non-compliance. Now they introduce a fine of at least 500 million for non-compliance with any obligation imposed by the Act, or imprisonment for a period of not less than 5 years, or both, upon conviction by a competent court of law. So these are the four um, key changes in the Finance Act. Then we have the risk service arrangement. Okay, there is no special arrangement between oil operators and the government other than the granting of oil lease license, operating license, and the operator bears all the risks, pay royalty on production, and pay profit tax on this profit. So that's a risk service arrangement. If you are going to a PLC, you know that you bear all your costs. You're only going to recoup it when you get money, when you hit gold. I say gold, you hit oil, and you get it in the way of cost oil. That's the only thing. You bear all the risk, you pay your penalty, you pay your tax, you pay your royalty. Then there is an oil and gas arrangement. Nigeria currently operates two contract arrangements to aid funding and exploration of oil and gas projects. Now, we have the joint ventures, which is under the Joint Ventures Operating Act. This is between oil companies and NNPC, with the NNPC representing the interest of the government. That's one. Then we have the production sharing contract. This is with the international oil companies. So the international oil companies can also, from here, come and do business without the NNPC involvement in it. Or they could even involve the NNPC, who knows? But that doesn't change the fact that NNPC will come and collect royalty money and come and collect tax money, royalty oil and tax oil. So that is the only thing. If NNPC is not involved, that is the only thing that will collect. But if NNPC is involved, NNPC will be involved in paying their own royalty money. They will be involved in paying their own tax money, and NNPC will now get profits. So, but here, when they are not involved, NNPC will collect all of this and maybe perhaps ask them to sell it and pay it into the NNPC's government account. Right? We now have the marginal field operators. Marginal fields are fields that are discovered usually by large international oil companies, but which as a result of focus on larger and more profitable fields were not developed and yet not relinquished. These are, however, of interest to small players and therefore represent investment potential for small companies. All right? The the marginal field operators might not be of much interest to us, but let's look at the conditions here. At least 51% of the beneficial interest of the company must be owned by Nigerian citizens, and no single shareholder may own more than 25% of the shares. So it means that for you to have 51%, you may need to have at least three companies. You may have at least three companies, because if two companies are having 50% as the maximum that they have, you must fulfill that 51%. So there must be a third company that must be of Nigerian citizen. The company must have upstream oil and gas experience, of course, and the company must have in their MEMAT. When you want to open your company with CAC, you want to register with CAC, you must state that you are going to conduct oil and gas exploration and production company. You know, some people when they want to open CAC, register a company, they want to one small company like that, they want to do everything. They will say they are into trading, they are into there's general contracts. You will see them hearing again consultancy, and you will see oil and gas. So that one here, I just put oil and gas. It could be anything. It could be that you are selling groundnut oil, or you are selling coconut oil, or you are selling refined oil. They are not looking, you are not being looked on as upstream. Just because you put oil and gas, you are looked at as downstream then. But for you to be in the upstream here, you must put in your MEMAT that you will conduct oil and gas exploration and production activity. And of course, there is a particular share capital you will have to pay or subscribe for you to get into this upstream. Now, the foreign companies may participate in the process either by incorporating a Nigerian branch with the Corporate Affairs Commission. So it means that if a foreign company is outside here, you want to participate, you will need to register a a company with the corporate affairs, and it will have to be a Nigerian branch. You know what, how we treated special businesses, Nigerian branch, foreign subsidiaries, things like that. So we are looking at something like that. As a foreign company has Nigerian branch. All right. Crude participation by indigenous operators who bears all the risk and take all the risk. So they have to indigenous operators, of course, will be Nigerians. The lack of incentives compared to joint ventures and production sharing contracts. So in this marginal field, they lack incentives compared to the joint venture and production sharing contract. Of course, we've seen some of the incentive in the PSC, 50% tax, 50% investment tax credit, and other smaller investments that you see there. Many operators unable to produce up to commercial quantity of at least 100,000 barrels a day. So it means that for the people who are going to participate, it may be that you are unable to produce commercial quantity of at least 100,000, 10,000 barrels per day. Then you fall under the marginal field operator. Uh-huh. The part I want to go here is the tax rate of 85% burden. Of course, this is the 85% which the joint ventures is also paying. 85% is the tax. Then the tax rate is 65.75 during the recouping period. So the recouping period is 4 years. So it means that if you have started for the first 4 years, your tax, the tax of these oil companies, joint ventures inclusive, is 65.75. So look at how I usually want you to remember this thing. Just look at it and say 65, 75, 85, like that. So you just put a dot here. So this is for the first 4 years. You see there are four figures here, 1, 2, 3, 4. So this is 4 years and they are paying 65.75. So from the fifth year, you can see there's 5 here. From the fifth year, you are paying 85%. So that way you remember it. It's just a memory guide. 60, 65, 75, 85. Put a point between the 65 and 75 and you look at it, there are 4 digits here. And you say in the first 4 years, which is the recouping period, this is the amount they are paying. After that, they are paying 85%. All right, upstream activities. These activities are related to acquisition of license, exploration of oil, development and production of crude oil and gas, treatment of oil and processing of gas, as well as transportation and delivery to export terminal, refineries or other processing plants. So it means that from where you are getting the license, acquisition license, to when you are searching for oil, when you have gotten the oil, when you win the oil, you put them in containers or so, the associated gas, you process it, and you take the crude to the export terminals or where it is going to be sent to the refineries. That is where upstream activities end. The actual the actual export itself is not the actual export itself, the transportation where it moves is not upstream sector. But when you have taken it to the export terminal, of course, the downstream are the ones that is going to transport it to the various places. So look at the downstream activity. The downstream activity as defined by the Nigerian Accounting Standard Board, which is now Financial Reporting Council, are those activities that take place from the receipt of crude oil into crude oil tanks or gas into petrochemical tanks to the transportation of refined products to the final user or of processed product to secondary industry. Now this include transportation, all these people that are telling you that they are working on a rig, or some people that are transporting the oil, people that are transporting the oil, of course, they are the downstream. The refining of the oil into the segment, of course, that is refinery. Then we have the liquefaction of natural gas. That is where we have um, liquefied natural gas. Um, yes. Then distributing and marketing of refined products. Of course, the filling stations are involved in the downstream sector and gas and derivatives. So any company that is engaged in the downstream sector are also subject to the Company Income Tax Act, and so their tax is 30%. Of course, you don't expect them, you don't expect their revenue to be less than 100 million. So their revenue will be more than 100 million. So that's why we're using 30%. You can't say that, otherwise I would have said that 25 million, if it's less than 25 billion, you will pay 0%. But of course, we are doing oil business, downstream sector, even a refinery, even petroleum station, petroleum companies, they don't deal with less than 100 million, and so it is 30%. All right, so let's look at some of the terms that is going to be used here. We have the accounting period. Like as I said before, the accounting period is 1 year, commencing from January 1, ending in December 31st of the same year. Now, when you want to commence business, you can get shorter period. So if someone commence business in June 1, of course, it will be from June 1 to December 31st of the same year. Or anybody is ceasing operation, it will now be from January 1 to the date when it ceases operation. These are the shorter period. But if you are in business continuation, it's from January 1 to December 31st. Now, we have revenue service, which we call the FIRS. Then we have the casing head petroleum spirit. So sometimes you will hear these words, casing head petroleum spirit. Any liquid hydrocarbon obtained in Nigeria from natural gas by separation or any chemical or physical process before this thing is being refined is called, I'm seeing some question here. This insensitive given to the joint ventures, is it the substitute that was removed in June this year? I can't say for now. I can't say. I will need to look at that act for me to be able to definitely say yes or no. So still seeing comment. The incentive, yes, I know it's incentive. I will need to check. Now, hydrocarbons, okay? We look at it that any liquid hydrocarbon obtained from natural gas by separation before they are refined is called casing head petroleum spirit. Now the casing head petroleum spirit can be now the refined, no, can be subdivided into two. One of them is chargeable natural gas and the other one is chargeable oil. So the natural gas actually delivered by a company to the NNPC under a gas sales contract, but does not include natural gas taken on behalf of the government. So here you will see gas contract. It's part of one of the things you will be seeing in your exam, gas contract, chargeable natural gas. Then we also have the chargeable oil, is the casing head petroleum spirit and crude oil won by a company from petroleum operations. So this is the crude oil. It's also called chargeable oil. So this is crude, this is gas. So both of them are called casing head petroleum spirit. So there is a natural gas, there is a crude oil. And I said before, sometimes they are gotten together. So you see associated gas. Sometimes they are done separately. You see, when they are done at association, when the gas is done in association with the crude oil, it means that the company did not set out to look for gas. They set up to look for crude oil, and when the gas comes as a jara, everything is going under crude oil. So even though a gas normally is given a particular profit tax, most times when it is going under the crude oil, it is the gas amount um, is immaterial compared to the crude oil. So it just falls under the crude oil revenue. What is crude oil? Any oil other than oil extracted by destructive distillation from coal, bituminous shales, or other stratified deposits, one in Nigeria, either in its natural state or after the extraction of water and sand or other foreign substances there. But before such oil is refined or treated, so crude oil is like, how will I say it now? Um, you bring out, let's say, you bring out a treasure from the ground, all right? You dig and you get a treasure from the ground. Let's say, let me just use yam as an example. Let's assume that yam is a treasure. You dig it from the ground, and all you just did was you clean the dust, you wash it, remove the sand, you clean the dust and make it well, and you take it to the market to sell. It's yam. But if you now start cutting it and you now make amala from it, or pounded yam, or you start frying it, it is no longer yam. It is now being called, it's no longer crude yam or so. It is now being called the other name. So crude oil is in its natural form. The only thing you are removing is water or sand or any foreign thing. But the moment you start treating it or refining it, which is being done in the refineries, it is no longer crude oil. Now, disposed or disposed of. Sometimes you hear this. In relation to chargeable oil, it is from crude oil owned by a company. Disposed or disposed of means delivery without sale of chargeable oil to a refinery or an adjacent storage tank by the refinery by the company. So when you are disposing, it means you are not selling, you are taking it to a refinery. Delivery without sale to a refinery or adjacent storage tank. So of course, when Nigeria is sending it to the refinery, they are not selling it, of course. They are disposing it to them. So the refinery will now, you know, refine it, and they will now be the ones to sell to the final consumer. Of course, the value of what is being disposed of is going to be ascertained. The value, so the cost value of what is being disposed of will be part of the revenue for the upstream sector. So it means that they are transferring the costs of this crude oil to the refinery. So they are not selling it, but of course you need to know the cost. That value, that cost is going to be added as the upstream sector. Of course, we know that part of the revenue for the upstream sector will comprises of sales of crude oil, foreign exports. So the exported sales, the one that they will sell locally. Sometimes the foreign, because the foreign sales is constituting 90%, so it is going to be very high. The local sales will be lower, very small. Then we also have value of chargeable oil disposed, which is the one that is sold. I didn't say, okay, there is one that's been delivered to the refinery. Then sometimes you will see value of associated gas. Then we have something called the G factor, which is called the gas factor. So we have the G factor, which is the gas factor that will be used to adjust the gas contract price. So the gas factor has a percentage where when you have a contract price, that gas factor will be used to reduce the contract price, because gas is effervescent, meaning that it can lose its quantity because it is volatile. It is I would say it leaks, it can leak. And so you can put a gas filled up and you just leave it. After a while, that quantity will have reduced on its own. And so it now depends on the G factor, the quality of the gas, and the G factor will now be used to reduce the contract value. We will see that when we are doing calculation. Then the High Court here, in relation to any offense, is the High Court in Nigeria. So this is about courts. Now let's look at intangible drilling cost. What is intangible drilling cost? Okay, so in upstream sector, you'll be seeing two things: tangible drilling cost and intangible. So the intangible, you will see the word intangible drilling cost. Those ones are not that material. So all expenditure for labor, fuel, repairs, maintenance, hauling and supplies and materials, not being supplies and material for well cement, casing or other fixtures, which are for or incidental to drilling, cleaning, deepening or completing wells for the preparation thereof, incurred in respect of the determination of well locations, geological studies and topographical and geophysical surveys. So let me not bore you with these technical details. In the exam, you will see intangible drilling costs. You will not be required to go and find out what are included in intangible drilling costs. So just know that there are intangible drilling costs as part of the things you're going to see in your question. Then we have the liquefied natural gas. This is natural gas in its liquid state. All right? We'll not be talking most of these things. Then we have, let's go straight to some of the things that are important. Royalties. The amount of rent for which there is provision for its deduction from the amount of royalties under an oil prospective license or oil mining lease, to the extent that such rent is so deducted. There are there are oil prospective license. So that's the first license either a joint venture or a PSC gets, oil prospecting license. You get that license in order to go and look for oil. You are going to look for oil. So looking for oil in prospective places. So When you have seen oil in commercial quantity, you have discovered that there is oil in commercial quantity, you don't have the right to lift it. You go back and collect oil mining lease. So when you get this oil mining lease or license, that is when you can now dig and bring it out. And so in respect to these licenses that you have, you shall be expected to pay royalties. Concession. This includes an oil exploration license, an oil prospecting license, an oil mining lease, any right, title, or interest in to petroleum oil in the ground, and any option of acquiring any of such right or title. So when they say they are giving you the concession to go and produce oil, to go and dig oil, to go and explore oil, when they say they are giving you the concession, they are giving you the license. So by the time they are giving you this oil producing prospecting license, they are giving you concession to do oil prospecting. When you come for mining lease, they are giving you concession. It's just like saying they are giving you the permission or the go ahead, a right to do that. Administration of Petroleum Profit Tax Act. The administration of the Petroleum Profit Tax Act is under the charge and management of the Federal Inland Revenue Service. The FIRS may do all acts as may be deemed necessary and expedient for the assessment and collection of the tax, and shall account for all the amounts so collected in a manner as prescribed to the Minister of Finance through the Revenue Service. So normally it's what we know, FRS is collecting the tax, even though sometimes they're collecting it from the NNPC. Some of the readable things here are plenty, so we'll be skipping to what is important. All right, so let's look at nature and classification of income. The oil and gas industry is characterized by certain factors that are peculiar to the industry. And one of these factors here is the time lag, which could be several years, between the time that an investment is made for the exploration activities to the time that the oil can be produced in commercial quantity, and also to the time it is being sold to generate income. So there is a time lag. Now, there is a high risk of uncertainty of the result that will be obtained from the exploration activity. So there's a high risk when you explore, you're looking for um, oil field, you're looking for where you get oil. There is risk and uncertainty, especially with the PSC. You may not find oil, and all your investment will be gone. The only conclusive evidence of availability of oil in any location can only be obtained by drilling. That is the only thing that will give you conclusive evidence. So all these people that are in rig, that are drilling, that is the activity that shows conclusively that there's an oil. Any other thing you are using to search for the presence of oil is not conclusive until it is being drilled out. The risk is very high of not finding recoverable oil reserves or not finding such in commercial quantity. So when you cannot find it in commercial quantity, your investment is gone. Statistics have it that on the average, oil will be found in commercial quantity in 1 out of 40 exploration well. Other risks that are present in the oil and gas industry are market risk, sovereign or political risk. Of course, when your country is in war, political instability is a risk. Some people will pull out of the investment. Partner risk, even taxation risk. All these will greatly impact on the investment and returns in the industry. Of course, we've seen some oil companies leaving Nigeria not to invest in Nigeria. I think we have the Total Energies that they went to invest in an African country instead of in Nigeria. These are some of the risk that will impact on the investment in the industry. Now, the very high returns in the industry compensate the very high risk. That's why they say the higher the risk, the higher the returns. So because they take very high risk, the returns is very high. And of course, the tax rate is very high. The industry deals in high volume of production with all the advantages of economic of scales. It means when you are producing very high, the cost will be reduced. Of course, you will make your profit in that. Financial returns are usually substantial whenever there are large finds. So profitability can be very high in period of high oil prices, especially like the time in 2008 when the oil price reached $145 per barrel. Profit will be very high. Of course, the costs you have spent, you spend the cost for a long time and you have not sold some of them, and now the oil price went high, your profit will be high. Now, the main sources of income I told us is about um, I mentioned four, right? We said sale of crude oil. Of course, I mentioned four. One of them is local and one of them is export. So this is equity share. Sale of crude oil. Sale of crude oil. Mostly it's exports. And when you are giving exports, just know that you will be seeing dollar. It will be given to you in the price will be given to you in dollar. Then you will see a currency conversion where you will now convert this dollar to naira when you are doing your calculation. Then we say have sale of gas, associated gas. It could be export, it could be local. Most times the gas is far lower than that of the crude oil. Then we also have income from lifting and sale of NNPC crude. NNPC crude. So this is for the production company. So when the oil producing company is selling for NNPC, NNPC will make them have profit. So the income they get from that, because the NNPC cost will be sent to them, the profit will go to them. So that's part of the income. Other items of income, for example, interest income. Interest income, if you borrow money to do the petroleum business, upstream business, and you are paying interest for those loans. So these are part of other incomes to be part of petroleum company. All right. Incidental income will be subject to petroleum profit tax. So it's not when you go and do a fixed deposit and they are paying you income. No, fixed deposit income is not under petroleum activity. But you went to borrow money and to do your oil business and you are paying back. Of course, these are um, some of the income. So we have ullage fees. These are incidental income, ullage fees, rentals, management fees, mineral property conveyors. Wow, I take back what I said. Interest on fixed deposits. Okay, these are treated as incidental income. Okay, so I take back what I said before. Fixed deposits. We get interest on fixed deposits. Of course, these are These are monies made from petroleum business, and you now went to fix a petroleum business, went to do a fixed deposit, and it's getting interest because it's taken as petroleum profit. Balancing charge on disposal of items of qualifying expenditure is also treated as incidental income. So balancing charge, when we are dealing with capital allowance, we said balancing allowance is part of allowances that will be reducing your taxable profit. When we have balancing charge is when you sell your assets higher than its net book value. The extra is balancing charge. In the case of petroleum company, the balancing charge when you dispose assets that are higher in value, you get higher in value than the net book value, it is taken as incidental income. Another point worthy of note in the determination of income in the oil and gas industry is that oil produced is deemed sold when produced. So it means that all the oils that have been produced in that period, they are deemed to be sold, whether you have sold them or not, whether they have sold them or not. As a result of this, the sales value of crude oil produced can be taken to income immediately without waiting until the time of actual sales. So normally, um when you are buying something and you put it in your shop and you have not sold it, it is going to just be stock. It's going to be stock, right? But in the case of this one here, that it's not taken as stock, it's taken as seen, it is deemed as being sold. So you're not going to be looking at opening stock, closing stock, because all they need to do is how many did you produce this year? That's all. How many did you produce last year? Maybe it may be that the last year own is being sold this year. When they are paying the cash, they are recording in their book that this is the amount that is being sold for last year. Or it is possible that you cannot record cash for this year until you have cleared all the past ones. So, but the important point here is as it is being produced, the barrels is being produced per day, they are selling it or they are taking it as being sold. Even though we have reserves, it is taken as being sold. Nature of cost. The relevant part of PPA is section 9, the comparable conditions stated in the section for the ability to allow for the allowability of expenses for tax purpose is that such must be incurred for the purpose of petroleum operations. So note that there was no specification that it must be incurred in the production of the income or profit. So the nature of petroleum operations business necessarily requires that certain expenses have to be incurred for the business that could not be tied to the income to the direct production of um the crude oil or so. So it is clear that such would have been incurred for the petroleum operations. So the fact that they have not produced income is recognized as the fact that they have not produced income is recognized in PTA as insufficient ground to disallow them in petroleum profit computations. Of course, so what they are trying to tell you that there are some costs that have not produced income. but they have incurred them, right? For example, we have outgoing or unproductive lease. We have non-productive rents. You see them as part of your expenses. Non-productive rents, they are allowable rent. Ongoing unproductive lease. Then we also have tangible costs directly incurred with connection with drilling and appraisal of development wells. Okay, so tangible costs. So these are all the allowable expenses. Some of them, these are here. Then we have exploration and drilling costs. Exploration and drilling costs. And this exploration and drilling cost is in relation to the first two appraisal well. These are deductible. Now, what happens is that sometimes in exam question, you will see that they will tell you exploration and drilling costs applicable to the first two exploration well, appraisal well is allowable. Sometimes they might tell you this is the total exploration and drilling cost. They might give you the cost that is applicable to the first two drilling well. They might tell you that they drill 5 wells. They will give you the cost for the first one, give you the cost for the second, give you the third, fourth, and fifth. All you need to do is take the first two. Sometimes they will just give you the whole and say this is for 5 or 10. All you need to do is divide it by the number of wells, multiply it by 2. You have gotten the first two drilling wells. All right. All sums by way of duty. So you see here, this is where taxes are also being allowable expenses. Normally, when you are doing income tax, company income tax, you don't remove taxes or stamp duties and other things as allowable expense. But here, custom duty, excise duty, even stamp duty are allowable. Education tax. Now, this is where I will also tell you certain things here. We have education tax. Now, education tax before now used to be 2%. When it now changes to 2.5%. Now, education tax will never be given to you as part of your computations or as part of the allowable deduction. You are the one that will include it because this is a company that should pay education tax. You are the one that will include it. And now there is a way they calculate education tax. Now, when you have your assessable profit, which is called AP, which is inclusive of tertiary education tax. Now, at this point now, you have removed all your allowable expenses and you have not removed tertiary education tax. That's the very last thing you should remove. So at this point now, you have assessable profit, which includes tertiary education tax. When TET was 2%, it means this is already 102%. When it is 2.5%, it means this is 100.2.5. Now, for you to get tertiary education tax, so your tertiary education tax will be 2 over 102 times this assessable profit that you just calculated, which is inclusive of TET. Or in the case may be, if it is 2.5 over, remove the percentage, 2.5 over 102.5 times AP. Or as the case may be, education tax has gone to 3%, it's going to be 3 over 103 times AP. So bear that in mind. Education tax is the last deductible or allowable expenses you should calculate, and this is the formula for it. It will never be given to you in the question. You are the one that will put that in your mind when you are doing it. Always, all sums by way of custom, excise duties, and other charges levied in respect of machinery, equipment, and other goods in the company's operation. Now, some people usually ask me that tangible drilling costs, why would I not add it? Why would I not add it to capital allowance? They are not added to capital allowance because capital allowance is treated separately. They said Section 10, deductible or capital allowance granted in accordance with the provision of the second rule. So they are deductible if you have deducted them from your if you have deducted them from your operational cost or from your accessible profit. No, if you have deducted them when you are calculating your accessible profit, you don't need to go and add them to capital allowance again because that will be double deduction because capital allowance will still be deducted. It will still be deducted. So normally some people will say, don't deduct them, add them to capital allowance. But the right way to treat it is deduct them to get your accessible profit. Don't add them to capital allowance because capital allowances, you will be removing them small, small because they are not deducted. Capital allowances is the assets. Don't add it as part of your capital expenditure because capital allowances are reduced gradually. But when you remove this intangible drilling costs, you're taking them off once. So that's the best treatment. All sums incurred by way of interest on an intercompany loan obtained under the prevailing open market. So it means that when you are taking a loan from your related party, intercompany loan, you are going to take them at arm's length and it is going to be allowable. So these are the costs that are allowable, the nature of cost, and these are some of the allowable costs. Of course, your normal rent, normal salaries, and all that are allowable. Now look at classification of costs in the upstream sector. We have the mineral rights acquisition cost, exploration and drilling costs, development costs, production costs, support and equipment and facility costs, then general costs. Of course, we've talked about mineral rights and acquisition costs. We will not talk about that much. Exploration and drilling costs, we said these are exploration in terms of drilling, and we said that this is particular to the first two appraisal wells. You may want to take time to read what these drilling costs are. Then we have the development costs. Development costs are incurred to obtain access to proved reserves and provide facility for extracting. Normally, they will tell you development cost. They won't be giving you all these jargons. Then the production cost is what is the recurrent cost. All the production activities is there. Even the cost of personnel, that's salaries, wages, all of them are also included in production costs. Then we have the support equipment. So when you have support system, repairs, warehousing, uh, other support All right, so now let's look at the profit of an oil company. How do we get the profit of an oil company? This is going to serve like the um, profit template. The profit of an oil company can be calculated after all of this has been done. Proceeds of sale of all chargeable oil. So it means that both the local oil or the exports. So this include export sales and local sales. So export is being converted to naira. Local is already given to you in naira. So the proceeds of all of this is computed. That's the first thing you do. Then the value of chargeable oil disposed. So this is to refinery. So this is to refinery. Then all income accidented to arising from petroleum operations. So all other incomes. So now how do we calculate all of this? So the first thing to do here is value of chargeable oil disposed. So this is for the proceeds of this proceed here, of course, you know, is the number of oil barrel multiplied by the price, export multiplied by the currency conversion rate, and you get your export sales. For local sales, it might be the number of barrels sold locally multiplied by the current naira rate. Then value of oil disposed, chargeable oil disposed. Now, there are three elements to this. This arise where a company is in both the business of petroleum operation and the business of refinery. So they are in the business of refinery. If they're in the business of refinery too, they will all the value of oil that is being sent to the refinery will be accounted for. Now the value of oil disposed, chargeable oil disposed comprises three things. Now, one, the value of oil as determined for the purpose of royalty. So of the actual value of that oil is calculated. Then the second one is any cost of extraction of that oil. Any cost of extraction. Then the third one is any cost incurred by the company in transportation and storage of that oil between the field of production and the place of its disposal. We'll talk about these things here. So value of crude oil, which is the A part for royalty purpose. This is how it is being calculated. First of all, find the quantity of oil produced. That's one. Reduce this quantity by accounting for loss through evaporation. That's one. Then, if there are any internal usage by the company, you remove it too. Then any reform to formation. So it means that you are sending it back to formation, you remove it. So that means all you need to do is what was produced minus the one from evaporation, minus the one that you are taking as internal usage, minus the one that you sent for reform. What you get, multiplied it by the adjusted posted price. Adjusted posted price. Then you have your value of oil for royalty purpose. Then we have allowable deductions that will enable you to get adjusted profit. Now, these are some of the allowable deductions here. Talk about rent. Any rent, both productive and non-productive. See all non-productive rent. So I'm telling you rent, productive, non-productive is there. All royalties are there. Okay. Then excise duties and other stamp duties are there. Then interest payable by borrowing for petroleum operations are there. Then some incurred by way of intercompany loans are there. Any expenses incurred for repairs of premises for the purpose of carrying on petroleum operation. Any debt incurred directly to the company and proved to be satisfactory to the board that has become bad and doubtful. So provision for bad and doubtful debts and even bad debts are also allowable. The deduction to be made in respect of doubtful debts shall not exceed the portion of the debt that has proved to have become doubtful during that period, of course. It should be specific. Then we also have included as a profit, okay, this is in relation to this number two. It should be proved to the satisfaction of the board that the debt in respect of which a deduction is claimed were either incurred as a profit from carrying on petroleum operations in the accounting period which they were incurred, or advances made in the normal course of carrying on petroleum operations. So that's it. Then we have other ones, any other expenditure, including tangible costs directly incurred in connection with drilling and appraisal of development well. We said two development well. Then, as what is being said here, where a deduction may be given under this section in respect of any expenditure, that expenditure shall not be treated as qualifying drilling expenditure for the purpose of capital allowance. And I told you that some people usually ask when you remove this tangible drilling cost. Don't take it as part of capital allowance. Take it as your tangible drilling cost. That's it. Any contribution to a pension, provident or other society scheme or fund which is approved. So the key word here is approved. Any sum or liability of which was incurred by the company during the period to the federal government or states or local government council by way of duties, custom and excise duties, education tax, all of them are allowable. Then bad debts are also allowable. Now let's look at some of the non-allowable. One, any disbursement or expenses that does not meet the REN wholly, reasonably, exclusively, and necessarily incurred for petroleum purposes are not allowable. Any capital withdrawn or any sum employed or intended to be employed as capital, so any capital expenditure, no. Any capital employed in improvement which is not repairs. For example, you're doing overhauling or refurbishing of an asset, or you are doing, yeah, anything that is capital in any capital repairs or so, any capital improvement which is not repairs. You cannot call it repairs, then it's capital in nature. Any sum that you can recover under an insurance or contract of indemnity. If you notice here, these things I called here are also not allowable in income tax generally. Now, here, rent of or cost of repair to any premises or parts of any premises not incurred for the purpose of petroleum operations. So it means that if you have rent and some of the rent Part of it is for petroleum operation, the other part is for downstream. The downstream part will not form part of the rent. So it means you have to separate your rent into upstream and downstream. Channel the downstream own to the downstream sector because they are going to be allowable deduction for downstream. The upstream sector will be, for upstream. So rent, you may be paying the whole rent for everything, but you need to know how you share it using the appropriate um, measure or appropriate basis of apportionment. Any amount incurred in respect of any income tax, profit tax or similar tax, whether charged within or outside Nigeria. So anything like if you are looking at VAT, looking at other things, it's not allowable. The one that is allowable is petroleum education tax, custom duties, excise duties, stamp duties. The depreciation of any premises, of course, depreciation is not allowed. Any payment into provident savings, widow and orphan or other society not approved by the board. So it means that you need to know some of those things that are approved by the board. If they are not among the ones being sent to, then it is not going to be approved. Now they said any custom duty on goods, including article or other thing imported by the company for resale or for personal consumption of employees of the company, or where the goods of the same quality to those imported are produced in Nigeria and available as at the time of importation were ordered by the company, those ones are not allowable. Then we also have any expenditure for the purpose of obtaining information. Then we have donations. Of course, donations are not allowable. There is no provision in PPTA relating to allowable donation. So when you see donations, all donations is not allowed. All right, we have accessible profit or loss. The accessible profit of any company shall be the amount of adjusted profit for that period after deducting any loss incurred in the previous accounting year. This is the same way we did for the normal thing. And now, after adjusting for education tax, of course. Now, treatment of losses in petroleum tax computation. We have loss relief. Just the same way that we have loss relief. Now, let's look at the chargeable profit. So, chargeable profit is gotten from after you've gotten your accessible profit. So now the first thing is we know our profit, right? Or we know our income. We've discussed about our income, sales of petroleum product exports, local sales, value of um, oil disposed, and other incidental income. All of these form your income. Now, after getting your income, we now removed allowable expenses, and we now have what they call accessible profit. Of course, you may be given a profit, net profit, you now adjust it to adjusted profit, or you get your accessible profit. I can call this one adjusted profit. Then, when you remove loss and when you add balancing charge So whichever is given, you may have loss and you may have balancing charge. You may not have loss, you may have balancing charge. You may not have balancing charge, you may have loss. When you made this to your adjusted profit, this becomes accessible profit. All right, this is just the same way we do our normal tax. You have your income, you have your allowable expense, you adjust for loss and balancing charge, get accessible profit. And that's fine. But what constitutes the income is specific to PPA, and what constitutes allowable expenses, we've seen it. Now, after you have gotten your accessible profit, you must need to remove your capital allowance before you now get your taxable profit, which is also called chargeable profit. Now, how do we get it? The chargeable profit shall be accessible profit less capital allowance. Now, how can we get our capital allowance? Normally, your chargeable capital allowances will comprise of three things. First one is you first of all get your capital allowance brought forward. Capital allowance brought forward for the year. Then you will need to get something called investment allowance for the year. Investment allowance for the year, you will get to find out investment allowance for the year. Then we have petroleum investment allowance. Then we have tax credit that is applicable to the PSC if applicable. Now, when you get all of this, you also have balancing allowance. You add everything together and you get a particular figure. Then you will need to go and compute a second figure, which is just like saying that you have your capital allowances figure. Then you are going to go and check the restriction. You now say it will not be to be restricted to two-third of accessible profit. That's the same kind of thing we want to do here. So all of these things here you've calculated is restricted to 85% of, so you will now do 85% of accessible profit minus 170% of investment tax credit, ITC, or petroleum profit allowance. So this petroleum profit allowance is for joint venture. This IT is for PSC. So you can't have the two of them. So either you have this or that. But this one is the annual allowance for the year. So either you put 170% of ITC or petroleum investment allowance. When you less it from this one here, then you have the part B of your capital allowance. So whichever is lower is what you are going to use. So whichever is lower. So it means that you cannot go you cannot go higher than this. So this is to ensure that the tax chargeable on the company is not less than 15% of the tax that would have been chargeable had no deduction been made for capital allowance. So when you calculate this, you restrict it to this. So you cannot be higher than this. So whichever is lower is what you are taking. It could be that these ones here you calculate are lower than this, then you take it. If they're higher than this, you now take this restriction. So now this is the template here. Profit for the period. Okay, you are giving the profit for the period. That is if you are not doing it straight. If you are doing it straight, you have income, you now deduct allowable expense. Yes, you deduct allowable expense. So this income for the period, not profit for the period, income for the period. You deduct your allowable expenses. Sometimes they call it Section 10 allowable expenses. Now, they said after necessary adjustment to eliminate transportation operations included. So all these allowable expenses, you will need to deduct them. Come and deduct tertiary education tax, specifically last. Then I will show you how you do it when you are doing a real life question. So this minus this will give you adjusted profit. After getting your adjusted profit, you need to remove loss relief. Okay. Now, it's possible that you may now need to add balancing charge, but some people will want to add it as profit for the period. No, mostly you add it here after getting accessible profit, because if you add it here, it will kind of reduce what you will be having as education tax. Then you have your accessible profit. You now remove your capital allowances. You now have what is called your chargeable profits. Now look at what we call qualifying capital expenditure. Incurred on plant and machineries, incurred on pipelines and storage tanks, incurred on construction of buildings. Then we see qualifying, you need to see the word qualifying drilling expenditure, not drilling exploration like the things you have there. You see the word qualifying, and these are capital allowance properties. Then allowances here. The condition for granting capital allowances, of course, is still the same thing as what we look at when you are doing your normal tax. The capital expenditure must be qualifying expenditure. It must fulfill REN for petroleum operation, and it must be owned by the company at the end of the accounting period. Then we have annual allowance. Now, just like normal company that we have annual allowance, the petroleum company has annual allowance, but it's restricted in such a way. Now, normally, different assets, different assets usually have their annual allowance rate, right? For example, we usually say motor vehicle annual allowance is 25%, which means you can use it for 4 years. Furniture and fittings is 20%, which means it can be used for 5 years. Building, industrial building is like 10%, which means you can use it for 10 years. That is for company income tax. For petroleum profit tax, we don't have that. All of these qualifying capital expenditure are seen as one, and they have only one rate for annual allowance, which is 20%. So what it means is that 20%, 20%, 20% for 5 years, 100% would have been done. But now what happened is that for the first year, you will charge 20%. Second year, 20%. Third year, 20%. Fourth year, 20%. When it comes to the fifth year, charge 19%. At no time must your net book value of your capital allowance be less than 1%. So the 1% is will be in the books until disposal. 1% will be in the book until disposal. Unlike for companies that are in the company income tax, where we say it is 10 naira that will be in the books. In petroleum company, it is 1% of the asset. So now if you look at this illustration here, a company bought this, look at assets brought forward. Look at the assets brought forward. We have 2019. Okay, now look at this year now. This is for the year ended 2013. So when they say 2013, that is the year ended 2013. That means this is actual year basis. So one thing you should know about petroleum company, it is done on actual year basis. Actual year basis. Actual year basis. So this 2013 is what is going to be done here. So what happened is that I usually tell myself 2013 minus 5. What will I have? I have 2013. So when I want to minus 5, I will still start 2013, 2012, 2011, 2010, 2009. So I will not go 2012, 2011, 2010, 2009, 28. I can even say 2013 minus 4. I will say 2013, if I say minus 4, will give me 2019. So what it means is that any asset in 2019 will be 19%. Sorry, 2009, 2009, any asset in 2009 will be 19%. Anyone that is before 2009 will be 0%. So what happened here? This 2023, okay, this 2019, you see it is 19%. Every other ones are in 20%. So that is what it means here. So what you need to do is look at the year in which the company is preparing its account. Know its actual year basis, right? Now, minus 4 years from it. Any answer you get, that is the year that must be 19% in the annual allowance. Any year before it is 0. So the other ones are 20%. You will need to remember this thing also when you're also doing petroleum investment allowance. Now, petroleum investment allowance is similar to an investment allowance that is in CIT, okay? Which means that it is done on the first year in which it is being used and it is not prorated. Now, what is happening here is that the petroleum investment allowance, this is for mainly for joint ventures. Okay, so with respect, okay, now for, as said before, petroleum investment allowance, so PIA is for joint ventures, whereas ITC is for PSC companies. Okay, so note that. Note that. Now for PIA, location of the asset is important. Location where of this asset is important. It could be that these assets are in onshore, which is land, or offshore. And now note that they are incurred on the first year of use. So it means that if we are preparing an account, like in this case now we are preparing for 2013 tax year, look out for assets that were incurred in 2013. Now we said this qualifying capital expenditure could be, where is it again? Qualifying capital expenditure could be incurred on plant and machineries, incurred on pipelines, incurred on buildings. So look out for those things that are incurred in that year in which you are reporting the profit. That is the only year you can take the PIA or your ITC. So location is important. Qualifying capital expenditure for in respect of onshore, I think it's 5% here that is missing. So here is 5% onshore, which is land. So the PIA is 5%. Now from onshore, deep down up to 100 meters is 10%. Then from 100 to 200 is 15%. Then up to 200, okay, above 200, it is 20%. Now this is for JV. JV do not go very, very deep. JV do not go very, very deep as deep ocean, deep offshore. So this is the PIA. You need to look out for location. Now, so you see here, annual allowance. You need to look out for number of years that is in use. PIA need to look for location. Now, sometimes they might give you location when they are telling you PSC. In PSC, we don't need location. We know that ITC, we've said ITC in PSC. Once you have identified PSC, you'll be looking out for ITC. They might call it PIA, but you yourself, you go and call it ITC. You just charge 50% of the assets. It doesn't matter where it is, whether it is in the sea or onshore or offshore, it is 50%. But when you are dealing with JV, look out for where they are located and charge appropriately. Now look at this. Company computation of petroleum investment allowance. Now this company, of course, you will see they will call it oil company or oil and gas company or petroleum company. That's how you know it is petroleum company. Incurred qualifying capital expenditure in 2012. So it means this year is what you're going to be looking at. Now up to 21 million. Of this, 15 million of this, onshore is 15 million. Onshore is land, whereas the remaining is for offshore. Look at the remainder. Now calculate the annual allowance, investment allowance. So annual allowance, you need to look at 20% of everything because it was incurred in 2012 and the reporting year is 2012. Of course, this is the first year of use. You just use 20% on it. That's how we got this 20% of 21 million. Now, for petroleum investment allowance, how do you do it? Onshore is 5%. So onshore, the 15 million is 5%, you have 750. Then the offshore, the one that is not more than 100 meters deep, we say is 3 million, you use 10% of it. 3 million, 10% is 300,000. The second one, which is here, is 15 million, 2 million, 15%, that's 300. Then the one that is 1 million, you know, is 20%. 20% is 200,000. So when you add your investment, petroleum investment allowance is going to give you this. Of course, if you want to know your capital allowances, total capital allowances, you need to add your annual allowance with your petroleum investment allowance and keep them on the one hand. If you have balancing allowance, you now add. Then you need to compare it with 85% of accessible profit less 170% of PIA. 170% of PIA. So this PIA you just calculated, you know that when you are doing capital allowance, you less 170% of it. That's the Nigerian tax law. Now, the calculation of balancing allowance and charge follows normal taxation principle. So we will not be talking about it too much. Now, we've talked about meaning of disposed of, value of an asset, we'll not be talking that much, apportionment. So let's keep it down to posted prices. So in our next class, we shall start talking about concepts, computation of posted price, adjusted price. Then it will be time for us to now start doing calculations on petroleum profit tax. So our petroleum profit tax part 2 will be starting from the computation of posted price. Someone is saying this one is long. It's very, very long. I just had to like take the time to talk about most of the theoretical parts so that when we are doing the practical aspect, I'll be referring back to it. So that's why we said PPT is going to be the last so that we will learn and practice more on it because believe you me, PPA is a compulsory question in your exams. So permit me to start from section 28.21, the next class, where we'll be taking it down to calculation and to be getting excited. So from the next class up to the other class, part 3 or perhaps part 4, we may have to do calculation. So thank you so much for coming to today's class, and very soon you will get your videos sent to you, and make sure you watch it. If you have not been watching any of the videos, make sure you watch the series of petroleum profit tax. This topic alone is capable of making you pass your advanced tax. So don't play with it. So you see, I'm not fast when talking about this. I'm deliberately slow so that you will get to understand this topic. So thank you so much for the time spent with me in this class. I will see you again in part 2 of this class. Good night.